When reviewing and discussing life insurance, we first need to understand what is insurance. I simply define insurance as a transfer of financial risk for events that are of low frequency but high financial severity. This concept is relevant for all of the insurance needs we'll cover, including life, health, disability, long term care, homeowners, auto, and umbrella liability. Since life insurance transfers the risk of a financial burden from a surviving spouse or dependents in the event of a premature death, the need for life insurance could be between moments' notice and possibly through the end of life. During this lesson, we're going to focus on term life insurance, which is intended to provide coverage for a specific duration, often between 10 and 30 years. And since term life insurance does not provide cash value, it is considered the purest and least expensive form of this risk transfer. We effectively want the insurance company to win, meaning if the insured person dies during the term, the insurance company can pay the tax-free death benefit to the designated beneficiaries. And if the insured lives beyond the policy's term, that's also a win for both parties, since the insured is still alive and the insurance company doesn't have to pay the benefit. Although it may feel like a waste of money to pay for life insurance you don't end up claiming, you're paying for the risk transfer and peace of mind along the way, not actually hoping your beneficiaries need to claim a death benefit. Considering the common term coverage options of level premium, annually renewable, and decreasing term, I have advised most people to purchase a level premium policy to cover them slightly past their family's anticipated financial independence year, which is when they'll be able to work because they want to, not because they have to. You may also consider the age of your financial dependents when discussing your desired insurance term, possibly choosing a 20-year policy versus a 10-year policy if you have young children, for example. And thankfully, if you reach financial independence before the end of the term, you can reevaluate whether to keep or cancel the policy. As the policy continues from year to year, the annual premium remains the same, but the effective cost of insurance actually goes down, which we'll see in more detail later. And lastly, you may also create term ladders if you expect the need for insurance to decrease over time, such as stacking 10-year, 15-year, and 20-year policies. But the administrative cost per policy should be taken into account. To prepare for this lesson, I asked dozens of financial planners how they technically calculate life insurance death benefit amounts. I use a preferred method with a financial independence framework, but I wanted to consider multiple viewpoints. Many financial planners and insurance professionals use rules of thumb, such as multiples of annual salary or expenses, while others prefer to consider a mnemonic. For example, life stands for L, liabilities, I, income supplementation, F, final expenses, and E, education expenses. And another popular mnemonic is DIME, which stands for D, death expenses, I, income replacement, M, mortgage, and E, education expenses. These needs approaches consider more personal variables than simply using a multiple of income or expenses. You may consider final and adjustment expenses, debt elimination, education funding, retirement needs for the surviving spouse, and other specific goals. To go beyond one-size-fits-all rules of thumb that hardly fit anyone, while at the same time avoid going down a rabbit hole assuming dozens of assumptions that are out of our control, I created this life insurance needs calculator that allows for a hybrid approach. Since I view life insurance with a financial independence lens, I prefer to ensure that a surviving spouse would be immediately financially independent upon the insured's death. Let's say for this example, the surviving spouse's age is currently 32, with a life expectancy age assumption of 95, an annualized inflation rate of 2.5%, and investment return of 8.65%, together creating a 6% annualized inflation-adjusted return. This assumes the life insurance death benefit and the investment accounts are invested for long-term growth and sustained purchasing power. Since their current investment balance would still be available to the surviving spouse, we include their $250,000 portfolio, also assuming it will continue to grow at that inflation-adjusted return. As an added note, inherited retirement accounts can be distributed without the 10% early withdrawal penalty before age 59.5. The surviving spouse's annual gross income need in today's dollars and other lump sum payment needs are both in blue because they influence each other. For example, this family has $225,000 remaining on their primary mortgage, and the would-be surviving spouse has mentioned they would like it fully paid off. By eliminating the mortgage, their annual income need would then be reduced, in this case down to $85,000 per year. Also keep in mind the life insurance death benefit would be received tax-free, but the future investment earnings may be subject to tax. This row, titled Other Lump Sum Payment Needs, may also include final and adjustment expenses, other outstanding debt, the education savings needs lump sum that we calculated during the education funding lesson, and other family savings objectives that you'd like to cover. Since insurance is that transfer of financial risk, it is helpful to discuss what's really at risk, but also what your surviving spouse or other dependents imagine their life to look like upon this significant event. When determining how much life insurance you need, consider less about how much you need and more about what your beneficiaries would need and prefer, in their own words. Death may be an uncomfortable topic, but this is a conversation to have when times are good. And beyond the conversation, I also think collaboratively reviewing this tool as a family can help you understand that your life insurance amount isn't just a rule of thumb, but instead that it's aligned with what your family claims is important, the ideal life of your surviving spouse, partner, or other dependents. To gain the clarity and confidence necessary to implement your decisions, you first need to understand what to do, how to do it, and most importantly, why it's being done in alignment with your life. Deeper conversations with your family will help you collaboratively define why you're buying life insurance. This calculator, alongside the review of your comprehensive financial situation, will help you determine what to buy. And lastly, the how comes down to working with an independent insurance broker. I've included some links below to compare quotes across carriers. I previously mentioned that level premium term life insurance effectively costs less each year. The effective cost calculation is the total premiums paid over the remaining term divided by the death benefit amount. For example, Susie Sampleton owns a pre-existing 20-year term life policy she bought in 2021. Let's say that she has 17 years remaining. The annual premium, $132, times 17 equals $22.44. Then, divided into the $250,000 death benefit, the remaining effective cost is 0.9%. This means if Susie were to die on the last day of her policy's term, between now and then, she'd pay less than 1% of the death benefit in total premiums, a relatively inexpensive way to transfer the risk of premature death. The cost of life insurance is naturally higher with applicant age and when health class ratings reduce down to standard and below. One of the benefits of buying term life insurance when you're younger is locking in your insurability, avoiding the future risk of chronic health conditions or other medical issues. The underwriting process may also be accelerated for younger, healthier applicants. You can download and edit this life insurance summary template, including your current coverage, individual or through your employer, and your future quotes, formatted on the Spreadsheet tab. In this example, Susie is currently underinsured with her 20-year, $250,000 policy. In their case, she and her husband Stevie could purchase new policies to right-size their coverage. Two important notes to mention as we end this lesson. You may also consider any Social Security survivor benefits that could become available upon your death for a surviving spouse with minor children or other dependents, and the dependents themselves. Now that we've covered term life insurance, let's move on to disability insurance, an even more common risk.